My name is Ewan Sneed and I'm the host today. So I'm the National Manager of Institutional Solutions at Colonial First Aid Platforms. Today's webinar is about managed accounts and the benefits of investing with an open mind. So managed accounts are becoming more of an essential way that licensees and advisors are implementing their advice. When thinking about managed account services, there's a couple of things to think about. The operational considerations that must be made, what factors ensure a successful managed accounts offering, how does the investment process tie in with managed accounts, and how to focus on fundamentals to your clients. So today we've got two presenters who are going to take us through these topics. So the first presenter today will be Tom Glynn, who's the Head of Wholesale for D&R Capital. He's going to share his key insights and extensive experience of in the funds management industry, particularly focusing on what he's learned from operating and managed accounts from the investment management perspective in delivering client-focused quality solutions. The second speaker today is Dushko Bajic, who's the Head of Australian Equities for Growth for Colonial First Aid Global Asset Management. He's going to discuss the benefits of investing with an open mind while maintaining the focus on fundamentals and how these attribute to the maximize the long-term returns to clients. So we're going to do an amazing piece of technology now. We're going to pass over to Perth where Tom Glynn is. So we're going to pass over now. So Tom, take control.
Okay. Did you do the share thing? Where did can you hear me there, Ewan?
Yes, I can.
Okay, can you see my screen?
It'll come up in a second.
Not yet.
Okay, bear with me 1 second. That amazing piece of technology. I have to go back into the link potentially. Where is it? This is it. Can you see the screen, Ewan?
I can see you, but I cannot see the presentation yet on the screen. Oh, hang on, it's just about to start right now.
Okay, sorry about that, everybody. Thanks for your patience. I'll get started, and thanks, Ewan, for the opportunity, and CFS for the opportunity to present today. I think when we were approached by CFS and IMAP, and in regards to what topics could we present, I was conscious of the fact that there is a prevalence of information around
Tom,
and the structure. And
yep, that's good now. We can see your slides now. Sorry about that. Yep, all good.
Okay, no problems. I was conscious that there is a range of information out there that people have access to. And I thought that having operated in the managed account space for 17 years, there might be some key learnings from D&R Capital that we could share, or maybe some insights into how we look at managed accounts, because I think the conversation can become overly complicated, or certain things that advisors do that they would approach differently if they had their time again. So I guess the intention today is to give you a very brief overview at the start of who D&R Capital is, to give you some context, and so that you understand any biases that come through from me. Give you an understanding of some of the questions that come up for us, some of the mistakes that people may make when constructing an SMA strategy, and then just some of the roadblocks that advisors encounter when putting together a managed account portfolio. And obviously happy to take questions at the end. So if I give you a very brief overview for context, we were set up in 2001 by two individuals that were working for a national stockbroker firm at the time. One was head of research, so he was the investment guy, and we had an institutional stockbroker who was looking after the client relationships. And one of the issues that we saw at the time was that if you were remunerated via transactions, then there was potential for conflicts. So you'd see the transactions tick up at the end of the month in order to get paid, not always, but the conflict was potentially there. But more importantly, if you were controlling the client relationship, but you were also controlling the execution of the underlying investments, the relationship became very emotive. So what you'd see is you'd either see the transactions tick up at the end of the month because of the embedded conflicts, or you would avoid a conversation with the client because you were avoiding a conversation around a stock recommendation that may not have gone to plan. And around about that time of setting up the business, it was around about the tech rec. And if clients had called the client who also looked after the equities advice to get some liquidity in the portfolio, there was a tendency to sell some of the better quality stocks to avoid the conversation on some of the stocks that may not have performed as expected. So we saw an opportunity to set up a business that continued to give clients direct beneficial ownership of the underlying securities, because we thought that's what high net worth individuals wanted. They wanted to see what was in the account, particularly out of downturns and in volatile markets. But we wanted to pair that with institutional quality asset management that they'd become accustomed to in managed fund land. So we thought about doing that through initially individually managed accounts. So we've had experience in that space, so I haven't answered any questions there. Increasingly through separately managed accounts on the likes of external platforms, being CFS Wrap as an example. And then the third sort of leg to the stool to our business are institutional clients. So as an asset manager, we have ended up where a lot of boutique groups do across those client types, but very much with a background in managed accounts. And you can see on the next slide, we've got a focus on Australian equities, 3 SMA capabilities, being the high conviction, the SRI, and the income strategy, and then the emerging companies, which is a small cap, which we're distributing through a unitised trust. And as I step through this presentation and talk about some strategies and philosophies that are suitable for the SMA environment, you'll get an understanding for why we're distributing that product via a trust. So if we look at very briefly where the market's come from and where it's gone in terms of developments in the SMA space, this chart here you would have seen before, potentially, if you've been looking in the managed account space. But the reason that I'm going through it is because it highlights how we talk about managed accounts internally and to the market. I think people can confuse the conversation or overcomplicate it, but effectively an SMA is an enhancement in technology that allows you to rebalance assets, in our case direct equities. It can be managed funds, exchange traded funds and the like, but in an efficient fashion. So from our point of view, it's not something new. It's just the way that technology is allowing you to do something that you've done in the past in a more efficient fashion. Sort of, we used to send faxes to communicate to people. We do it via emails in the main, but fundamentally what we're doing hasn't changed, and it's no different with SMAs. So pre-1980s, if you're an ultra high net worth individual, you might have approached a stockbroker to get direct equities advice. In post-1980s, you've been able to get institutional quality asset management through retail funds. Then you were able to get them through a wrap account. Now via an SMA structure, you can access the direct equities, you can access the managed funds via a wrap account. So it's just bringing them together. So nothing fundamentally new, just technology enabling you to do something you've done in the past in a more efficient fashion. So if we move on now, managed accounts with that as a background can include most assets, but the focus of this presentation, given our background, will be on direct Australian equities, managed through an SMA structure and distributed via an external platform like CFS, Wrap and Choice. This is information that will be familiar to a lot of you, sort of the benefits or the differences in the SMA structure relative to a managed fund, but I'll cover them very quickly before I move on. A managed fund is a unit trust structure. So in this example, you've got $100,000 going into a unit trust, which gives the investor an entitlement to a return on the underlying assets, which happen to be listed securities there. If the securities go up in value, unit price goes up in value. If it goes down in value, unit price goes down in value. All the SMA is doing is removing that trust structure and making the client the beneficial owner of the underlying assets. And by doing that, you open up a number of benefits. And a lot of these have been well trawled over, so I don't sort of anticipate going over all of them in detail. But we do think there's one that does get forgotten and will increasingly become important as time goes on. And that's the ability to transition assets not only into the SMA, which gets talked about, but the ability to have flexibility to move those assets over time. So when talking about SMAs, the most commonly cited ones will be the access to professional investment management. You've continued to get managed fund land, the tax efficiency of not investing in a pooled structure, And obviously the transparency, the daily transparency that you get. And generally at the end of the meeting, they will talk about the operational aspects of moving into an SMA. But they'll rarely spend a lot of time talking about the benefits that that will pose to the client long term. And I've tried to illustrate it below. But because the client's the beneficial asset of the owner of the underlying assets, in this case listed Aussie equity securities, they can interspace the assets into the portfolio, but they can also move them around throughout the term of their investment life. Okay, so client advisors will continually look at fees on asset management, which is a pragmatic way to go about things, trying to reduce them where possible. They will look at fees on administration, again, a correct way to go about things, but they're happy to put the client into an investment structure that gives them limited flexibility to move over time and can prove to be really costly. And in this case, I'm referring to managed funds. So if you've got a 30-year-old client, you put them purely into a managed fund portfolio, you could be doing that under the assumption that they're going to stay in those funds through to retirement, so the next 40 years, or a reasonable assumption would be that they're going to move over time. So that might be due to changes in circumstances, which means you have to adjust the asset allocation. It might be underperformance of a managed fund, which means that you have to move. It might be a change of portfolio manager. But if that happens within a managed fund structure and you want to move, you have to fully redeem that client's assets in order to move it, okay? And that may come, particularly for an accumulator in non-pension phase, at significant costs in terms of percentage points. If you invest that client into a managed account from the age of 30, you will give yourself significantly more flexibility to move the assets. You may well have to redeem all, but if you're moving from DNR Capital to another Aussie equity SMA, you may have to only redeem 30% of the portfolio or 40% of the portfolio. And if you are able to do that when you're making changes, whether it's 5, 7, 10, 15 times throughout the life, the investing life of the client, you're going to significantly reduce costs for the clients. And then I think the other message that you're sending to the asset manager is the ability to hold them more accountable for results, because an asset manager operating in the managed account space, their fund is much more fluid than one operating in a managed fund space where you've got to consider those embedded capital gains before moving. So what I'm trying to say there is, look, consider the professional investment management and the transparency and the tax efficiency overall, but don't underestimate the ability to be able to move the client's assets via an SMA over the term. Moving on to style analysis in a transparent environment. I'm not here to educate people around which styles are better and which aren't, and which part of the market cap spectrum you should play. I'm just more trying to acknowledge the fact that there are different considerations when operating in a transparent environment rather than a pooled or a one line item environment. What I'm trying to say here is, when you're constructing a portfolio, just be really conscious of your client profiling. And you can see the blue boxes is where DNR Capital operate. But if you've got a deep value investment style, which is perfectly fine and very effective, you might be investing in the stocks that are on the front page of the paper. Fantastic investment opportunities, but could be alarming for clients. So is that appropriate for them to be seeing through, and do you need to educate the client around how the portfolio is going to be populated? And likewise, if you're putting a high growth strategy into a transparent environment, which might come with increased volatility, what's the sophistication of your client base and how prepared are they for that volatility? And then likewise, how familiar are they with equities? Are they going to be more familiar with the banks and resources? Are they going to be familiar with some of the mid-cap names like REA and car sales? And then will they understand any of the small cap names? So familiarity with some of the holdings through time will give them comfort around the portfolio construction, but inevitably some of those holdings that they don't know might be the ones that contribute to alpha. So just sort of using this matrix when constructing a portfolio to go, okay, if I'm going to take on more volatility by going into the high growth space, do I need to push it up the market cap to ensure that they're more familiar with the stocks to give them comfort, or vice versa? So just sort of a way to think about construction. Moving forward, diversification, the one free lunch, I'm sort of posing the question. I'm not here to espouse the benefits of diversification or disprove them or otherwise. I'm just trying to make you aware of how portfolio construction might work in a transparent environment. And we've sort of all been indoctrinated into the benefits of blending different styles in the managed fund space, and that might include blending a value manager with a growth manager and then incorporating a style neutral for the core of the portfolio. But if each of those managers has a position on an individual security, say one's completely getting out of BHP, one's entering for the first time, and then the other's trimming or selling, that will flow through to the transaction statement. And depending on how that transaction statement looks, you may not be able to reconcile where that trade has come from. So be able to allocate it to one of the managers. So just be conscious of that when the potential to be sitting down with a client with a 30 or 40 pages of transaction history and trying to reconcile what's going on in the portfolio. And one of the fallouts of having multiple SMAs in a transparent environment is that if there is the sort of trading that you see at the bottom of this slide, there's the potential for the client to perceive that there's a lack of cohesion in the overall construction. So typically what we would see when advisors do this is that they would consolidate one or two or all of the SMAs into one, or they would choose a core SMA, whether that's a growth or value or style neutral, and then choose to use managed funds around the fringes, whether that's a mid-cap or a small cap strategy. Okay, so just be conscious of your portfolio construction and how that looks in the statements. Manager communication has been trawled over significantly, so I don't intend to do that here as well. Obviously, you want to make sure you're getting the answers to the questions that your clients will inevitably ask. But what I would say is just bring that conversation forward. When you're doing manager DD, don't make it the last question that you ask. And I think the importance is understanding how that communication comes through and how consistent that is with how you've communicated with your clients in the past. So typically you've used videos to educate your clients and keep them updated. Is the manager going to provide that to you? Okay, how consistently and how often? Slide 11, technology is a fantastic thing and it's bringing about a lot of efficiencies in the advice space around investments and portfolio construction. But what I'm just trying to say here is just be conscious that technology also lowers the barriers to entry. We've got the definition of quality here from the Oxford Dictionary, which says that the standard of something as measured against other things of equal or similar kind. And I think the standard of a direct equities SMA is really the managed fund equivalent. And there's been DD structures in place for some time that have served us well. And I think it's important for us to maintain that same discipline when looking at SMA structures and new entrants into the market. So look at the 4 Ps, the people, size of the team, the philosophy. Is it appropriate for a transparent environment? The process, has it been proved up through a cycle, and the performance, what does that look like? And things to look for are the viability of the firm, their break-even fund levels, operational DD, corporate governance structures, and importantly, and has always been the case, independent external verification of all of those things, whether that's via external research ratings or reference checks from institutional clients and the like. And I think just rounding that out there and not to labour on it is just to understand the motivations of for moving into the managed account space, because without doubt, it does come with increased client servicing obligations, increased transparency around your portfolio and the activities. So how much effort are you going to be allocating to servicing the clients in that space? I am conscious of time here, so I'll go through slide 12 reasonably quickly, which is the last slide, but it's effectively covering off some of the key roadblocks that advisors have found when approaching clients about managed accounts, and I've certainly encountered when talking to advisors that are entering this space. And again, positioning this around direct equities, SMAs, but a common one that comes up when talking to clients or adopting is, how do I tell clients that I'm no longer managing their direct shares, which has been a big part of that advice practice's value proposition for a number of years. And there's no sort of panacea or perfect way to approach this, but a common way that advisors do it is sort of 2 prongs. One is that they'll continue to provide that non-discretionary service, the SOA equities advice that they've become accustomed to in the past, but to introduce a discretionary service along the side, which is the SMA environment, and then just educate the client around the pros and cons of each, and allow them to make the decision. But increasingly, given the compliance burden of FOFA and advisors being acutely aware of the risks associated with managing equities internally, they're just educating the clients around the fact that technology has improved, and separately managed accounts wasn't necessarily readily available to retail investors in the past. Technology now makes that available to them, and would they be interested in considering it going forward? Okay. But one thing to always remember, and this can sort of be something that advisors work out at the coalface or in hindsight, is that you do lose a level of control. So in the market, we do talk about the efficiency benefits, which is absolutely right, and access to professional investment management, but you are losing some of the bespoke nature of the portfolio services that you might have offered in the past. So what advisors will do there when they start to integrate it into their business is consider SMAs for non-bespoke clients. So if they're suffering some inefficiency issues within their practice and they're struggling to grow, they can use SMAs to be able to continue to scale up their business, and they will approach new clients with this new value proposition. So they wouldn't be familiar with that non-discretionary service they were offering in the past. And I think the technology is improving so much on the likes of platforms like CFS Wrap that you can get somewhere in between. So you can get the efficiencies of outsourcing through a model portfolio, but through that improved technology still have some influence over the underlying mandate. And here are some of the examples of what CFS will allow you to do, which is substitute in another asset, replace an asset, hold or exclude an asset, not buy or sell. So you can have influence and still get some of the efficiency benefits, but you still need to understand what the limitations are before you step into the space. For direct equities practices, SMAs increase fees. I think that is in most cases, a guarantee. You could argue you get the efficiency benefits on the other side. I think advisors historically have entered the direct equity space for a number of reasons. One, they think that they add value from a performance perspective. Two, it's an acknowledgement that clients like direct access to underlying investments. And three is that they're trying to reduce the cost to the client. I think one of the consequences of integrating that into your business is that you do build up some inefficiencies because of that tailored portfolio. But the one thing that people don't spend a lot of time talking about or analysing is the performance slippage from that delayed execution. So if you're accessing investment IP from a broking firm or research house, and then you're implementing that with a delay, whether that's via your 6-monthly review, you're doing it on a monthly basis, the performance slippage is material. And in a lot of cases, and some of the instos have done work on this, the performance slippage is significantly more than the MER. Okay, so you're building inefficiencies into your practice by doing the equities yourself, and potentially costing the clients some money on the other side. And happy to talk about that offline. And then look, to round things out, transaction costs are important. So you should be asking questions to the manager around how often they trade and what the level of turnover is. And depending on whether the platform charges a percentage-based fee, and I CFS don't charge any brokerage, so it's not a concern there, or a dollar-based fee, that will determine whether the asset manager is expensive or cheap, depending on how often they trade or how often they turn the portfolio over. So look, that's my time up, and I appreciate that it was really quick. Trying to just generally give some insights into how DNR Capital see the SMA space, some of the queries that come up for us when we're talking to advisors around the country, and some of the things that you should potentially think about before entering the space or constructing portfolios on behalf of clients. Ewan.
Awesome. Okay, thanks everyone. That's Tom Glynn, the head of wholesale for DNR Capital. So if you pass across control back to us in Sydney, we'll now pass over to Dushko Bajic, who's the head of Australian Equities Growth for Colonial First State Global Asset Management. So over to you, Dushko.
Thanks, Ewan. Thanks to CFS and also to IMAP for the opportunity to run through this presentation, and thanks to the audience out there for taking the time to listen in. Slightly ambitious task here that in terms of the presentation I want to run through in a short 20 minutes, but I'll run through what it is I'm going to go through and why at the start to give you some context, and then we'll whip through the slides relatively quickly. So the benefits of investing with an open mind, I think what I want to take you through is how that works in our team and why it's important to start with. After that, I want to talk a little bit about our investment philosophy. So we're an Aussie equities manager with a growth investment style. Then we're going to move through a specific area of research. That's an example of keeping an open and curious mind. And it's a piece of work that we've done on companies that are in the software as a service industry. There's some quite famous and successful examples of such companies in the US. But we also want to highlight the fact that there are some examples in Australia and New Zealand as well that are investable, and that not only does the US have this sort of core competency, but it exists in Australia as well. It can quite often be overlooked, and we think it's also really under-researched because many people approach new technology and companies with these abilities with quite a closed mind. So I'll run you through some detail there. Following that, I want to sort of focus in on valuation discipline that we apply, because it's just not a matter of just buying everything in the space. You've also got to be careful what price you pay. But we also go through why some of these stocks in Australia in particular can hold high multiples, because I'll run you through the unit economics that sit behind that. After that, I'll propose to show you how SaaS stocks and our focus on growth style investing has helped our portfolio outperform the benchmark, our SMA X20 portfolio, how that's outgrown the benchmark off the back of this kind of work. And then I'm going to ambitiously segue into some macro consequences from the capital expenditure that comes with SaaS and the productivity gains that come with it, and how that might be very constructive for equity markets in terms of their outlook from here. So moving through the slides very quickly. So I think an investment process is really at its core about generating ideas. A rich set of ideas can then be implemented through a nice disciplined fundamental investment process to generate a portfolio that outperforms. But before we get there, what are the important elements that you really need to be successful? And carrying an open mind is really important. I think it sits within an investment culture. And it's really important that you have an environment that encourages idea generation and fosters independent thought. It's also important that you sit in a team that has investment acumen. Our team has sort of 20 years plus experience, and we've got a really extensive network of industry contacts. But that's not enough either. You also need to have the analytical rigor to be able to put the models together and then also not get lost in the detail of modeling. And finally, you just need to draw those qualities together and have some capability in markets in order to generate ideas that are profitable. But underlying all of that is having an open mind. It's very important. Moving on to our investment philosophy, we're a growth style investment manager. We look for companies that can generate consistent returns and grow faster than the market. And it's also really important that these companies are able to attract both debt and equity capital and invest it in such a way that they're earning a return above their cost of equity and above their cost of debt. And that then becomes quite self-sustaining because those retained earnings can be reinvested in the business and into the assets of the business to maintain that growth trajectory. That's a key tenet of our investment philosophy, and I think it's very natural in equity markets to want to look for companies that can grow cash flows, because that's essentially why you want to invest in equities. Otherwise, you can just buy yourself a bond and get your fixed coupon and get the principal back at the end of the term of the bond. I think it's quite natural to really want to invest in stocks that can grow their cash flows and, in fact, justify the equity risk premium you take on by actually owning a minority holding in an equity. The other important part of our philosophy is also we recognise that changes in returns on invested capital are quite powerful drivers of returns, and there's some whilst they'll never be the majority of our portfolio, there's always a couple of examples in the portfolio where you can do well out of that. And it's some recent examples in the last couple of years that are not typical growth stocks, but stocks where they've had a catalyst. There's been a change in the industry structure. Has enabled us to do well out of them, and like a BlueScope Steel, a Qantas and a Flight Centre are good examples where there's been a catalyst either in terms of industry capacity on the Qantas front with Virgin exhausting its balance sheet, or in terms of Flight Centre sort of getting risk. There's some risk to the founder for him to be taken over by virtue of the fact that he hasn't really run a lean business, and that made him get a bit more serious on the cost front, and that enabled us to buy the stock at 30 and exit at 50. And BlueScope Steel is an example as well in terms of steel spreads. Finally, how do we go about it? We really have a big focus on doing deep industry research. We do our own bespoke research. It's not desktop research. We go and do surveys and talk to industry experts and former competitors in industries and with companies. And we find that that's really useful, and we get some independent data sources, and we also sort of takes us away from the increasingly lower quality of broker research. Now, moving on to software as a service, this is really important. I want to explain what this is because it's a really important phenomenon that's happening out there. Essentially, it's a licensing and delivery model. The key thing here is these companies, and I'm talking about this from a consumer perspective, they're centrally hosted pieces of software, and essentially what happens is there's no need for an internal IT network or server, so you're escaping your own IT team. You can access from a web browser or your iPad or your phone. And I'm talking great examples like Salesforce here, which many of you may have some familiarity with, or if on the accounting side, Xero is a great example. The other thing that's interesting is you get better security, and I think the product develops more quickly because it's being essentially developed by various customer requests globally. And the big difference here on the economics of the model is there's no upfront fees. So let's go to MyOb, another accounting software example. So traditionally, people bought a perpetual license for $800, and they may or may not update that for the next decade, depending on how many tax code changes there are. But if you go onto a sort of a SaaS model with Xero, you're essentially paying a $50 a month fee, and you're getting that product developed in the background by Xero. And every time you log in, that product is got 99% on time and working, rather than having to deploy to each single computer in your network, a stale copy from a CD-ROM of a perpetual license from something like an MYOB. Interesting thing about the business model here is you can really run into some deep losses initially because you've got all the fixed costs of starting up and developing the technology. And the other thing is you've got the burden of customer acquisition costs. But if you can really find a successful model and also a capital market that supports a company and provides that equity capital in order to burn through that those startup losses, what happens at the end is you get some really excellent returns because the revenue growth is very stable. It builds monthly, and what you find is customers really gravitate towards these companies because essentially the product's better, and you start on-selling usage-based revenues per amount of gigabyte consumed, depending on how many customers you're using, or per transaction. If you're something like a WiseTech and you're doing cross-border transactions. And what that means, you get really fast-growing, stable revenue if you're one of these SaaS companies. But the really important thing is not to stop, because sometimes the faster you grow, the bigger your losses are. The really important thing is to find an equity market that will actually support that investment and let those underlying unit economics flow through. When I talk about unit economics, when these companies move past their startup phase, underlying gross margins end up being 80 to 85%, and they start spitting out return on equity, return on ROIC north of 20%, so really attractive rates of return. Just a quick example here of the lifetime value of a customer, and I'll use MYOB as an example again. This just shows that once you get a customer on a subscription model, if you've actually got a really good product and they stay with you for 10 years, which you can work backsolve from the churn rate in your customer book, you could actually end up getting extracting 2.6 times the value versus an upfront payment of $800 once off 1 year, and with the client never updating over the next decade. So that works for the company in terms of its profitability, but it also works for the customer, and works for the customer because they're paying those monthly fees, but those monthly fees match revenue that they're generating, customers that they're serving. And also, I've got a slide later on in the pack, it takes away your internal IT cost in terms of deployment and maintenance of sort of stale one-off on-premise licenses. And the customer ends up winning as well because they just move away from the really clunky IT that most organizations have, and that costs a lot of money. What companies are out there that are really interesting? I think there's a myth that there are no companies in Australia or this part of the world that are successful, and that it's dominated by the US and Silicon Valley and San Francisco. So I've just got a couple of examples there. Let's focus in on the US companies. So well-known names like Salesforce, Workday, Adobe, they're very well known. And that's a 5-year chart. The black line there is their revenue. So you get this incredible sort of 20% per annum revenue growth, and it's very, very stable. You can just see it by the slope on the line there. It's just because it's monthly revenue, more customers, higher ARPU, customers are purchasing more modules, and it's just ultimately really flows to the bottom line. There are also some great companies in Australia which we invest in, and WiseTech's a wonderful example of that. That company's got faster revenue growth, and it's earlier on in its life, but it virtually has no competition in terms of cross-border commerce. It's basically deals with booking transactions, cross-border import and export markets is what it's focused on, and it charges per click. And you might think, well, why would a customer do this? But one of its biggest customers, DHL, tried to create this platform, and they spent $600 million, 3 years, and then wrote it down to zero, because essentially they asked their own IT department to develop it. And this is the cost you're getting away from when you switch to being a SaaS customer on a piece of software that really works, and you create sort of a network effect that's actually profitable and generates internal efficiency within your own business. Xero is another great example. It's quite interesting. There's a lot of New Zealand's very focused in terms of value investing. A lot of the stockbrokers have a real value focus, and also the buy side has a real value focus. So it didn't really have an equity market. The blue line's the share price, and as you can see, it sort of fluctuated around a lot. That's because it was sitting in an equity market that didn't really understand where they were headed, and actually re-domiciled a bit over a year ago to Australia, to a set of investors like us who've arguably done the work and got the vision to support them to make those investments and really win in terms of small business accounting software. So they're number one in Australia. They're number one in the UK. They're really taking market share from Sage. Excuse me, just trying to run through this really quickly. And they're also making good progress in the US, although they've got an equally competent competitor in terms of QuickBooks, Intuit in the US. I'll move on, but there's a couple of companies down there that are interesting on the bottom part of the slide, Autodesk and Microsoft. These are businesses that did have your traditional on-premise software, and they saw that was not the future, and then they flipped their business models into SaaS monthly fees. And most people will be familiar with Office 365 as an example for that. With Microsoft, and Autodesk does CAD, computer-aided design software. But when you make that flip, your revenues really fall. Like, have a look at Autodesk. It's very, very painful that their revenues fell 25% before they started growing again. But their margins now are way higher, and they're better for it. But you need to have a shareholder base that can sort of support that transition. Who are these companies destroying? Have a look at the revenue lines of these companies. They're not growing at all. They're the old big names, but that's all really expensive on-premise software that's deployed by internal IT teams that's really inefficient. Oracle, SAP, IBM, Sage, and MYOB are all, in our view, dinosaurs that are really losing out to these new and nimble companies who are building a SaaS client base. Now, what do you need to be really careful of, and this is where you really got to focus in on the fundamentals, is what kind of price you pay for these stocks. And yeah, you can see on the right-hand side there in that chart, you've got Xero, Altium, and WiseTech as good examples in Australia, and they are trading at high premiums. But there's a reason for why they're trading at such high multiples, and the way we value these stocks and look at them and compare them to competitors is a ratio of enterprise value to sales growth plus margin. And these companies in Australia have faster sales growth and higher margin than most of their competitors in the US, for example. How does this translate into the portfolio? Well, I've just got a chart there on, so if you look at the blue line, that's the next 12-month forecast EPS for our portfolio. So it started at 100, and we're just indexing this a year ago at the end of March. And the EPS, the evolution of that next 12-month EPS over the last 12 months has meant that that's grown by 20%. And you look at the benchmark, this is the X20 SMA, the evolution of growth in the benchmark has only been 8%. So you just see how this can translate into a portfolio, how we can translate this research, these ideas and these valuation methods into value add in the portfolio. Just want to highlight again the fact that, the real key thing to understand here is how much internal efficiency you're generating to your clients once the client goes onto a SaaS cloud-based product, away from its own on-premise deployment of a piece of software. You basically move away from your own IT department, which has a heap of training, maintenance, IT personnel, hardware, and customization costs that are hidden below the waterline. Whereas in the SaaS environment, really all you need to do is customize which data fields you want to use and populate, and then just train your staff. And what customers discover is the productivity of staff grows immensely because of the simplicity of the system. Couple of observations I want to make on the size of the market. So the corollary of SaaS companies is the cloud. So on the other side of SaaS is the data hosting and the data centers. So that's a proxy for the growth of SaaS businesses. And the interesting thing I want to draw out here is have a look at this market. So the cloud infrastructure spend last year was $80 billion US. And that market grew by 46%. So there are very few markets. Challenge anyone to find a market in the world that's $80 billion US in size, whose year-on-year growth was 46%. So if you're not understanding this trend, if you're not putting the work into understanding what this means, you could well be stuck in a group of dinosaur companies who are going to be obliterated by the competition, who's moved on to modern, fresh, and agile software, and something that's really resonating with clients. I might skip over this. Point I really want to make is I think a lot of the market is underestimating how big the cloud and SaaS market can be. The smaller pie chart on the left is, if you look at the green field there, that's just existing IT spend, and a lot of people, that's about $1 trillion, and a lot of people think, well, SaaS will just replace that, so the size of the SaaS market is $1 trillion. But I think that's a real misunderstanding of how big a market SaaS could be, because there's a whole new series of workloads and new businesses that get created off the back of this technology and the back of the efficiency that comes from AI and the usage of AI and to inform your business. So we're just saying that the market's underestimating how big this market will ultimately grow to. Best thing here is you move away from your internal IT department, and essentially, this ends up being shadow IT spend, something that they don't touch at all, and that actually directly relates to clients and to revenues that you're banking today. And just the final point I want to make is, just got a chart here, long-term Capex in the US economy, and you can see in the last 2 years, Capex has, from not growing at all, has sort of started to grow 7 or 8%. Cloud infrastructure investment is a big part of this return to higher Capex growth in the US, which is helping the economy. Important thing here is that it leads to productivity gains with about a 2-year lag, because you're getting capital deepening in the economy, but it also keeps unit labour costs low. So notwithstanding the fact that it's very positive that you're getting 3% plus wage growth in the US, due to the productivity gains, unit labour costs are actually not growing too fast, and margins are being held. Best thing here on the next slide is, as a dividend to the economy, you get low inflation, and the markets have now worked out to expect lower inflation. That also is quite positive for equity markets. And final thing here is, you read almost every day in the newspaper how risky a time period we're in now, because we've got a very flat yield curve, and the flat yield curves always tell you a recession's around the corner. Well, I think what the market is missing here is that productivity growth plus labour force growth equals higher potential GDP, but it also means that potential GDP can be achieved with low inflation. And so the picture I'm painting here is, yes, we could well be in a Goldilocks scenario. What scenario is very similar to today's scenario? Well, I take you back to 1994 to 1999. We had a flat yield curve for 4 or 5 years and no recession. We had a flat yield curve for that time period, and we had GDP growth that was above 4%. Roll forward to today. We've also got a really flat yield curve, and we've got growth that's returned to 3% in the US. And what I'm saying here is, we could well be worrying ourselves needlessly and missing some pretty good equity returns, because essentially strong growth without inflation is Goldilocks for equities. And I'll finish with the final slide here. If you look at the dark line here, that's the rolling 1-year return for the US equity market. And the blue line, there is the Purchasing Managers Index, which is starting to fall off. And that's what the market's worried about. The market's worried about economic weakness. But what we're saying here is, there's a productivity dividend that's coming to the economy, and that's real, and that you can forecast and that you can see. And for those 4 or 5 years between 94 and 95, Goldilocks returned 20% plus year-on-year returns in the US equity market. And I think whilst everybody's fearful of that, that's exactly what gives me confidence that that may well be the scenario that plays out in the next couple of years. Thanks for your time.
Excellent, thank you.
I'll just stop the share.
We'll just drop this shared screen and we're going to move now to questions. So probably the first question I've got for you, Dushko, is you've talked a lot about cloud-based information technology in your presentation. Are there any other sort of tech sectors that you're looking at, like fintech, bio, all those other areas as well, or are you mainly saying the area of focus is the cloud-based?
Yeah, no, that's a good question. I think I just drew out cloud and SaaS because it's interesting, it's under-researched, and a lot of the articles you get to read in the newspapers really don't lift the bonnet and understand the mechanics of how it works. But no, in the spirit of keeping an open mind, there's quite a few other examples in Australia that are interesting. And in terms of biotech, CSL is a real global leader in its marketplace. And it's been a very successful investment for us. And again, that's a story of a company that's reinvesting in R&D and generating an asset base and intellectual property that they're able to monetize and serve critical healthcare needs. And another slice, if you like, is another way to slice that and look at biotech is A2 Milk. Yeah, it's a stock that's done very well for us, and that's a it's a really innovative company. It's got a product essentially that has no competition, and that has really resonated with customers. So no, it's not just in IT. No, it's not just in SaaS. You've always just got to test the hypothesis, do the work, and come to a conclusion and value that cash flow stream.
Cool, excellent. Tom, I'm going to flick over to a question with you now. So the question is going to be about SMAs. So obviously we've seen a huge growth in SMAs in Australian equities. What are your thoughts about international equities with SMAs?
I think my view is that the adoption will come. So I think there is this growing appetite for transparency in everything to do with asset management. There's certain asset classes that make that difficult, like real assets. But I think in the listed space over time, you'll increasingly see more adoption of listed property trusts, adoption in the international space. I think it'll be much slower than Aussie equities. And I think the inflection point for Aussie equities was regulation. So FOFA, you had the compliance burden. And we'd already had this embedded home bias where people had direct Aussie equities portfolios that were readily available to transition into an SMA. So you've got this growth from that perspective. And then there was the risk within the practice, which has been highlighted by the Royal Commission around direct equities advice. And typically you haven't had that in the international space. So you haven't had advisors managing direct equities internally. You haven't necessarily had that home bias where you've had clients coming in with a lot of demand for that service. So I think where the demand will come from is sort of the need for 100% transparency in the underlying portfolio, which will mean that it's a slower burn. So you just won't have that transition benefits of advisors transitioning equities across. But over time, because clients are getting access to information in real time about nearly everything that they do in life, I think they'll demand that in listed space in any asset class where it's possible.
Cool, awesome, thank you. Just got another question for you. So what you've gone through today is a lot of focus on the new world sort of investment themes. So does that mean that other sort of old world, I guess, like resources, energy, those sort of sectors, does that mean who value investing has mainly focused on, does that mean that you don't focus on those? What's the view? Yeah,
Ewan, good question. Actually, no, we focus on everything in the investable universe, and the lens through which we view everything is, can these cash flow streams grow? What is the return on invested capital in a company, and how do we value that? And you brought up resources and energy. In terms of those exposures, we actually overweight resources. We're overweight BHP and Rio, for example, simply because they have world-class assets. They're both of their, those Pilbara iron ore mines that they both own are in the lowest quartile of the cost curve of the global industry. If you like, we are, as the Qataris are to LNG and gas markets, and the Saudis are to oil. The Saudis are pumping out oil at less than $10 a barrel cost. BHP and Rio are that to iron ore globally. You know, we are, that's the market position we've got, and also means that those companies enjoy really high returns. And ironically, I think that you know, differentiator in terms of performance over the last 12 months in particular actually has been whether or not you've been overweight resources or not, because they've done particularly well. And you'll find that quite often that you know, that hasn't been the case in value managers' portfolios, because they're sort of quite focused on the mine life that sits in these companies and the fact that they may or may not be able to replenish them. Whereas I'm pretty confident my children and my grandchildren will still be consuming steel products from iron ore that steel's been made from iron ore from the Pilbara in Australia. So I'm really confident that those mine lives will extend, you know, many decades, 50 years plus, and generate a really high return. On the energy side, we're a little bit less bullish there. I think, you know, we're constructive on the economy. So, you know, we think the oil price will hold up, but the issue is not the oil price. The issue is in Australia, the Australian stocks do not hold those low cost curve positions. We're actually close to the middle of the cost curve, and in some cases high in the cost curve. In the case of a Woodside, as an example, that as a result of that company can only generate a return on equity of 8%, which is sub its cost of capital. So we're not keen on stocks like that. So again, stock specific and looking at it through sort of a very fundamental lens.
Cool. Another question for you, Tom. So when you're a licensee or an advisor and you're thinking about SMAs for the first time, what are some of the questions that they don't ask or they probably should ask when they're considering using SMAs?
Oh, look, I think that's a good question. I think it probably goes back to my presentation. I think that the thing that they do ask, but they ask it too late, are the communication that you get from the manager, and then they're in a position where they've got to try and negotiate comms that the manager currently doesn't produce. So I think they start the relationship with a misalignment around the servicing. So that one, they don't ask that question early enough, and I do feel as though they probably don't go into the same amount of rigor as they do in the managed account space, in the managed fund space. Sorry, so I think there's sort of these embedded structures that they go through that have been tried and tested through various cycles around DD for managed funds, but I think they probably don't go as deep in the managed account space given that it's new. So their understanding of the space is less, so they're less inclined to ask the questions that are probably of value. And then the one that we really see often, and advisors do it with us, is blending multiple SMAs. And they do end up having to adjust it after the client's set, once they see those multiple transactions coming into the transaction statement. So it's probably those three things that will drive a better outcome for the client, I would have thought.
Awesome. Excellent. Thank you. So that's a wrap for today's webinar. Firstly, I'd like to thank IMAP for allowing us to be involved in today's webinar about managed accounts and the benefits with looking at an open mind with investing in those. I'd like to thank Tom from DNR Capital over in Perth, and it was great to see that Zoom works well when we can share between the wonders of technology. Maybe like a bit nervous when we've got cameras looking in your face. Yes. And Dushko from Colonial First State Global Asset Management, thank you for taking us through your concept as well and shining a light on how your portfolios work. It's really valuable. That's it from me. Thank you for attending, and if you have feedback, please send that through when the feedback forms come through. Thank you very much.
Thank you.
Thanks, John. Pleasure.